In this video, I'm gonna be teaching you how to trade options on Robinhood. So I've gone ahead, I've deposited $500 into this Robinhood account, and we're gonna cover how to place an option order. So first things first, you're gonna wanna click on the magnifying glass to decide obviously what stock you want to trade. You're going to look up that ticker. Now let's say Tesla is the stock that we want to buy an option contract on. Now you are going to go to trade. If you don't see the trade options button at this point, you have to actually go into settings and get approved for options trading. They're going to ask you your risk tolerance, your trading experience, and they're just looking to see that you're ready to actually put on degrees of risk and that you know enough to actually approve you to trade options. So once you've done that, now you should see the trade options button. We're gonna click on that button, and across the top here, you can see we've got all of these dates. Now these dates are our expiration dates. Now remember, with options, you have to choose a date at which point your contracts expire. Now the closer that date, the riskier those contracts are going to be, and the further away that date is, the safer those contracts are going to be. So if you are day trading and you plan on only holding that position today, buying and selling within the same day, that is a day trade, you could buy contracts that still expire 7, 8 months plus, or even a year out. But if you are swing trading, you definitely want to buy contracts that expire at least 2 months out. I've seen a lot of people day trade contracts that expire the same day, but just remember, the closer the expiration, the riskier the contracts. With myself personally, I'm a swing trader. I'm gonna buy contracts that expire at least 2 weeks out, nothing within 2 weeks, okay? So let's say we wanna swing trade and we're gonna buy these October 4th contracts. These are about a month out. Now, you can see here, we've got buy call selected. Now remember, you never want to sell a contract. Why would you sell something that you don't own? If you hit sell, selling a call or selling a put could actually open up your account to unlimited downside and maximum risk exposure. You never want to do this. You always want to be on the buy side. And then you could decide, obviously, whether you want to buy a call or whether you want to buy a put. Now, a call, you're just betting on the direction of that stock to go up, whereas a put, you're betting on the direction of that stock to go down. Really, options is not that complicated. Now, you can see we've got our share price, which is the current share price of Tesla at $219.87. Now, when looking at what is called the options chain, what you can see here, well, we can see what is under the current share price. This section, so the 215 calls, the 210 calls, the 205 calls, the 200 calls, these are what are known as in the money contracts, because the actual strike price is below the current share price, okay? Whereas on the other hand, if you're looking at a contract, say the 220 calls, the 225 calls, the 230 calls, these are all going to be considered out of the money contracts. And they're out of the money because they're above the current share price. Now with puts, it's the opposite. Anything above the current share price, the 220s, the 225s, the 230s, these are all in the money. And anything below the current share price, the 220s, the 215s, the 210s, those are out of the money. Now, what is the difference between in the money and out of the money? Well, in the money contracts are inherently safer. They have what is known as more intrinsic value. Whereas on the other hand, out of the money contracts are inherently riskier. They have what is called extrinsic value. Now, all you need to know is that obviously buying an in the money contract is going to be safer. They're not going to be as volatile. They're not going to move as much. You're not going to be able to make as much, but you're also not going to lose as much. Now, how do you actually decide what option contract to buy? Well, that's all going to come down to your risk management. And the easiest way to go about seeing how much money you'd make or lose on an option contract is by going to a website. For example, an options profit calculator. This is a free website you can access, or if you have a different broker, see if they allow you to actually simulate out option contracts. I know they do on the broker I use. So what you can do is go to an options profit calculator, find the same contracts, and use that to determine and figure out what contracts you're gonna buy. Now I cover that all in detail within my masterclass, and I actually created what I call a risk management calculator, which essentially automates this whole process for you. But again, when it comes to what contracts you're gonna choose, this is gonna boil down to your risk management and the way you go about trading. But let's say after using the options profit calculator, after using my risk management calculator, if you are inside my mentorship group, which I will put a link in the description below if you're looking to learn how to become a consistently profitable trader. However, let's say we're gonna buy some Tesla calls. We're gonna buy the 220 calls. So all you're gonna do is you're gonna click on the plus, and then you're gonna click continue. Now, you can see here, I've only got $493 available in my Robinhood account. Next, you can see the order type. We've got limit orders, stop limit, market, and then we've got a couple other options, but you're gonna be using a limit or a market order. Now, a limit order is essentially an order that allows you to choose which price you'd like to pay for a select contract, or if you own those contracts, which price you'd like to sell those contracts for. Well, a market order is essentially going to fill you at whatever price a seller is looking to sell those contracts to you for. So remember, the stock market is a marketplace. If you're trying to buy contracts, well, someone's gonna be selling them to you. And if you're trying to sell contracts, well, someone's gonna be buying them from you. So you can go in with a market order if you really don't care how much you pay for a set of contracts. If you just want to get in, market orders will get filled faster, whereas a limit order, your limit order might never get filled, or it might end up taking a long time to get filled. However, I, in most cases, use limit orders. And if you click on limit, you can see here, we've got what is called the bid and the ask. The bid is what buyers are looking to buy at, and the ask is what sellers are looking to sell at. And the difference between the bid and the ask, this area is called the spread. Now, when you place a limit order, you are able to decide what price you'd like to get filled on those contracts. And we can see here, the bid is $15.30 and the ask is $15.60. Now remember, because options are leveraged 100 to 1, that is not $15.30, that is $1,530. So obviously these contracts are way more than I could afford because I only have $500 in this account. So I'm gonna go back and I'm gonna choose a set of contracts that we would be able to buy, which look like the 270 calls are going for $280. Again, we're gonna continue. We're gonna make sure our order type is limit. And we can see here the bid is $258 and the ask is $280. So that means our spread is $22. Now, I would preferably like to pay the least possible for these contracts. So I'm gonna send in a limit order for $258. Now, again, this might not get filled. I might have to cancel the order and put in another limit order and pay a bit more. If we click review, now you can swipe up to submit that order. It's gonna say order received, and then you're gonna see, okay, if it will say 1 of 1 contracts purchased, that means your order got filled. The limit price, $258, the bid and the ask, and current position is 0 contracts. So if you don't get filled, you're gonna go to replace order. Okay, if you wanna get in that position, again, like I said, we might have to pay a little more. You almost for certain, if you pay the ask, will get filled at $280. But we don't wanna pay $280. Let's try to get filled at $265. So not quite in the middle, more toward the bid side. Let's click review and swipe up to send this through. Now, let's wait and see. And based off the contracts, some contracts are going to be traded more, some will be traded less. When it comes to liquidity behind the contracts, and when it comes to two variables, the volume and the open interest, well, these are two things we can look at that are going to tell us if we're really realistically going to be able to get filled on a contract, if we're going to be able to trade that contract, and if we're going to be able to get out of that contract. Does that make sense? So if we hit replace order, we're still not getting filled. That probably means that there's not a whole lot of liquidity. There's not a lot of people buying and selling these contracts. So for the example of this video, I'm just gonna go in at ask. Okay, so 279, we're gonna review and we're gonna send this order through, and you will see that I get filled almost instantly. Okay, I'm gonna click on done. Now, if you scroll down, you can see I've got one position open. I'm currently down 2.51% or $7. I'm down because the bid was much lower than I got filled. I paid ask, so I actually overpaid about 2.5% for these contracts. So they're really worth 2.5% less. Now let's say I'm ready to close my position, whether I hit my stop loss or take profit. I'm gonna click on the order, click on trade, click on sell, and then obviously I've only got one contract, and we are presented again with the option to choose our order type. And we can see now the bid is 265 and the ask is 279. And because I'm selling these contracts, well, now it's the opposite. I want to make the most I can selling these. So I preferably would like to get filled at 279. I don't want to go with the bid at 265 or I'm going to lose a whole lot more. So let's see if I can get out at ask at 279. Okay, review. I'm going to send this through, and we'll see if we can get filled. So what we have just done is we have put this contract we own on the marketplace, and we are saying, hey, all buyers out there, if anyone wants to buy from me, I will sell to you at $278, right? There's gonna be a little difference here because of the fee. Robinhood takes 0.03 per contract, but this is what I am looking to sell these contracts for. Someone can come in, they can buy them from me, or they might not. And for the purpose of this video, we're gonna hit replace order, and then I'm gonna go ahead, go back here, and then I'm gonna go ahead and let's try to get filled at 270, and we're gonna review, swipe that up, and we'll see if we get filled. Again, this is somewhere in the middle, and it looks like we got filled almost instantly. Okay, we're gonna hit done, and obviously we ended up taking a $7 loss or 2.5%. Now, we want to make sure, like I said, that these contracts have enough liquidity. You can see here the volume is 58 on these contracts and the open interest is 24. Now, what does that mean? Well, the open interest means that there are 24 contracts that are currently open. 24 people bought these contracts and they currently have them. Okay, it doesn't necessarily mean they're for sale. There's just 24 that are available in the marketplace, but have not yet been put on the marketplace, right? Now that I sold my contract, I am not part of that 24. There would have been 25 prior to me selling that contract. Now, what does the volume mean? Well, the volume represents the amount of contracts that have exchanged hands on that given day. You can see the volume is 58. Because I bought one contract and sold that one contract, well, I have actually contributed to that volume. And if I didn't take that order that you just saw, the volume would only be 57. Now that is everything you need to know about how to trade options on Robinhood, but how do you decide what stock to trade and what direction to bet on it going, or where you're right and where you're wrong? How much you're gonna make and how much you're gonna lose? Well, don't worry, I'm here to help. I've actually been trading for the last 8 years. I've put together a mentorship to take you from beginner to advanced, giving you everything you need to become a profitable trader in the stock market. Now, if you're interested in applying for my mentorship and learning more, click the first link in the description below, subscribe for more, and I will see you all in the next video. Later.